How to harness algorithmic trading for intraday success. Introduction. Intraday trading, with its rapid pace and high stakes, presents a challenging yet lucrative opportunity for traders. However, achieving consistent success in this domain requires not just technical expertise but also strategic foresight. One emerging strategy that is gaining traction among savvy traders is incorporating sustainability criteria into their algorithmic trading models. This approach not only aligns with the growing emphasis on environmental responsibility but also leverages the financial benefits of investing in sustainable businesses. Sustainable investing, often guided by environmental, social, and governance (ESG) criteria, is not just a trend but a powerful approach to achieving long-term profitability. Integrating these principles into intraday trading through algorithmic methods allows traders to capitalize on the growing market for green investments while managing risks associated with unsustainable practices. In this video, we'll explore how you can harness algorithmic trading for intraday success by focusing on 3 key strategies: screening for sustainability, aligning with green trends, and monitoring regulatory changes. By integrating these elements into your trading process, you can enhance your decision-making, mitigate risks, and ultimately boost your trading performance. Strategy 1. Screen for sustainability. Point 1. Incorporate ESG criteria. Environmental, social, and governance (ESG) criteria are becoming essential benchmarks for evaluating the sustainability of companies. By integrating ESG factors into your algorithmic trading models, you can identify stocks that are not only profitable but also sustainable. Example 1. ESG scores integration. One effective method is incorporating ESG scores from providers like MSCI or Sustainalytics into your stock selection algorithm. These scores provide comprehensive assessments of a company's sustainability practices across environmental, social, and governance dimensions. An algorithm can be programmed to favor companies with high ESG scores, ensuring that your investments support businesses that are committed to sustainability. For instance, if a company's ESG score exceeds a predefined threshold, the algorithm could increase the weighting of that stock in your portfolio. Example 2. Carbon footprint analysis. Another approach is to analyze the carbon footprint of companies. Algorithms can be designed to prioritize stocks of companies with lower carbon emissions. This not only supports environmentally friendly companies but also mitigates potential risks associated with carbon taxes or regulations. By incorporating data on greenhouse gas emissions, your trading model can screen out companies with high emissions and favor those with robust strategies for reducing their carbon footprint. This proactive approach helps manage regulatory risks and aligns with the global shift towards decarbonization. Point 2. Conduct sustainability screenings. Beyond ESG scores, conducting detailed sustainability screenings can further refine your stock selection. This involves evaluating the environmental impact, resource efficiency, and sustainability initiatives of potential investments. Example 1. Renewable energy adoption. Consider focusing on companies that are actively adopting renewable energy sources. An algorithm could prioritize stocks of companies with significant investments in solar, wind, or other renewable energy projects, indicating a commitment to reducing reliance on fossil fuels. For example, a company that has announced substantial investments in solar power infrastructure could be weighted more heavily in your portfolio. This aligns your trading strategy with the global transition to renewable energy and positions you to benefit from the growth in this sector. Example 2. Waste management practices. Algorithms can also screen for companies with exemplary waste management practices. For example, businesses that have robust recycling programs or innovative waste reduction strategies can be flagged as favorable investments, aligning with the goal of reducing environmental impact. By integrating data on waste management practices, such as the percentage of waste recycled or initiatives to reduce single-use plastics, your algorithm can prioritize companies that excel in these areas. This not only supports sustainable practices but also identifies companies that may be less exposed to future regulatory penalties or consumer backlash related to waste management. Strategy 2. Align with green trends. Point 1. Invest in eco-friendly sectors. Identifying and investing in sectors that contribute to environmental sustainability can provide lucrative opportunities. Green trends such as renewable energy, electric vehicles, and sustainable agriculture are gaining momentum and present promising investment avenues. Example 1. Renewable energy stocks. Investing in renewable energy companies, such as those involved in solar and wind power, can be highly rewarding. Algorithmic trading models can be fine-tuned to identify and capitalize on trends within the renewable energy sector, taking advantage of the sector's growth potential and societal benefits. For instance, algorithms can be set to monitor news and financial performance indicators of companies in the renewable energy sector, executing trades based on positive developments such as new government incentives or advancements in technology. Example 2. Electric vehicle market. The electric vehicle (EV) market is another green trend with significant upside. Algorithms can monitor and trade stocks of companies involved in the EV supply chain, from manufacturers like Tesla to battery producers, ensuring that your investments align with the shift towards sustainable transportation. By incorporating data on EV sales growth, government subsidies for EVs, and technological advancements in battery efficiency, your algorithm can dynamically adjust its investment strategy to capitalize on the rapid expansion of the EV market. Point 2. Support circular economy initiatives. The circular economy model, which emphasizes reuse, recycling, and sustainable resource management, is gaining traction. By investing in companies that support these initiatives, traders can tap into a growing market while promoting environmental sustainability. Example 1. Recycling technologies. Companies developing advanced recycling technologies represent a valuable investment opportunity. An algorithm could be programmed to identify and trade stocks of businesses that are innovating in recycling processes, thus supporting the circular economy. For instance, companies that have patented new recycling technologies or those expanding their recycling infrastructure can be prioritized. This approach not only supports environmental goals but also positions your portfolio to benefit from the growing demand for efficient recycling solutions. Example 2. Sustainable packaging. Investing in companies that produce sustainable packaging solutions is another way to align with green trends. Algorithms can track and trade stocks of firms pioneering biodegradable or recyclable packaging materials, benefiting from the increasing demand for eco-friendly products. By monitoring developments in sustainable packaging, such as new materials or partnerships with major brands, your algorithm can make timely investment decisions that capitalize on this expanding market. Strategy 3. Monitor regulatory changes. Point 1. Stay updated on evolving regulations. The landscape of sustainable investing is continuously evolving, with new regulations and policies being introduced regularly. Staying informed about these changes is crucial for adapting your trading strategies accordingly. Example 1. Carbon pricing mechanisms. Governments worldwide are implementing carbon pricing mechanisms to curb emissions. By monitoring these regulatory changes, your algorithm can adjust investments to favor companies with lower carbon footprints, mitigating the financial impact of carbon taxes. For example, an algorithm could be programmed to reduce exposure to high-emission industries when new carbon pricing policies are announced, shifting focus to companies with proactive carbon reduction strategies. Example 2. Sustainability reporting standards. New sustainability reporting standards, such as the EU's Sustainable Finance Disclosure Regulation, SFDR, are shaping how companies disclose their environmental impact. Algorithms can be designed to prioritize companies that comply with these standards, ensuring that your investments align with regulatory expectations. By integrating data on compliance with these reporting standards, your algorithm can favor companies that are transparent about their sustainability efforts and likely to meet future regulatory requirements. Point 2. Anticipate future regulatory trends. Being proactive about future regulatory trends can provide a competitive edge. Predicting upcoming regulations and adjusting your trading strategies in advance can help you stay ahead of the curve. Example 1. Anticipating green bonds growth. Green bonds, used to finance environmentally friendly projects, are gaining popularity. Anticipating increased regulation and support for green bonds can guide your algorithm to invest in companies issuing these bonds, capitalizing on the trend towards sustainable financing. For instance, your algorithm can monitor announcements from regulatory bodies and financial institutions regarding green bond initiatives, allowing you to invest early in companies likely to benefit from these developments. Example 2. Preparing for stricter emission standards. Stricter emission standards are likely to be introduced globally. By anticipating these changes, your algorithm can prioritize investments in companies that are already compliant with future standards, reducing regulatory risks and positioning your portfolio for long-term success. For example, algorithms can track legislative developments related to emission standards and adjust investment strategies to favor companies with advanced emission control technologies or those transitioning to cleaner energy sources. Conclusion. Incorporating sustainability into your algorithmic trading strategy can lead to both financial and environmental benefits. By screening for sustainability, aligning with green trends, and monitoring regulatory changes, you can create a robust trading approach that not only drives intraday success but also contributes to a more sustainable future. Stay informed, adapt your strategies, and leverage the power of algorithmic trading to achieve consistent, sustainable intraday trading success. The integration of sustainability into your trading practices is not just a strategic advantage but a commitment to fostering a greener and more responsible investment landscape. Happy trading!